Welcome to this PhD seminar on 3 Pillars of Capital Markets Research. This handout, titled 3 Pillars of Capital Markets Research, offers an in-depth exploration of capital market theories. Today's roadmap outlines 3 interconnected research streams in capital markets accounting research. Capital markets research in accounting examines how accounting information is produced, disseminated, and used by participants in capital markets. Over the past 5 decades, this literature has evolved into several distinct but interrelated streams. This handout provides an overview of 3 foundational pillars. 1. Capital market research, broadly defined. 2. Value relevance research. And 3. Earnings management research. For each pillar, we discuss its intellectual origins, core research questions, key methodologies, seminal studies, and current frontiers. Understanding these 3 streams is essential for any doctoral student in accounting because they represent the dominant paradigms through which accounting scholars have sought to answer the fundamental question: does accounting information matter for economic decision-making, and if so, how? Now we focus on capital market research in accounting. Capital market research in accounting, CMR, is an empirical research stream that investigates the relationship between accounting information and capital market variables such as stock prices, returns, trading volume, bid-ask spreads, and the cost of capital. The central premise is that if accounting information is useful for decision-making, then the release of such information should be associated with observable changes in capital market indicators. CMR emerged in the late 1960s as a direct response to the normative accounting research that had dominated the discipline. Prior to CMR, accounting scholars debated what accounting should measure, often arriving at contradictory conclusions without empirical grounding. The paradigm shift was catalyzed by 2 landmark studies published in 1968. Ball and Brown, 1968, demonstrated that unexpected changes in annual earnings are positively associated with abnormal stock returns. This was the first large-sample empirical study to show that accounting earnings convey information to the stock market. The study introduced the concept of cumulative abnormal returns, CARs, and established the event study methodology in accounting research. Beaver, 1968, showed that trading volume and return variability increased significantly during the week of earnings announcements, providing direct evidence that investors react to accounting reports. Together, these studies established the positive accounting research paradigm and demonstrated that market-based empirical methods could be used to evaluate the usefulness of accounting information. Understanding why accounting information matters in capital markets requires grounding in the theory of the firm. The modern firm is a nexus of contracts among various stakeholders: shareholders, managers, creditors, employees, suppliers, and regulators, each with potentially divergent interests. This contractual view, formalized by Jensen and Meckling, 1976, and further developed by Fama and Jensen, 1983, provides the economic rationale for the existence and role of accounting information in capital markets. Agency theory, the dominant framework in this literature, posits that the separation of ownership and control creates agency costs arising from moral hazard. Managers may shirk or consume perquisites, and adverse selection. Managers possess superior information about firm value. Accounting information serves as a monitoring mechanism that reduces these agency costs by providing verifiable, periodic reports on managerial stewardship of firm resources. The demand for audited financial statements, mandatory disclosure requirements, and debt covenants tied to accounting numbers all stem from this contractual perspective. The contracting perspective generates 2 distinct roles for accounting information. The valuation role concerns the use of accounting data by investors to assess the present value of future cash flows, and thereby determine firm value. The stewardship, or contracting, role concerns the use of accounting data in contracts that align the interests of managers and other stakeholders, most prominently, executive compensation contracts and debt covenants. Jesdal, 1981, and Lambert, 2001. Demonstrate that these 2 roles can create conflicting demands on the accounting system. Information that is most useful for valuation may not be most useful for contracting, and vice versa. Positive accounting theory, Watson-Zimmerman, 1978, 1986, builds on this framework to predict how managers will exercise discretion over accounting choices. The three central hypotheses, the bonus plan hypothesis, the debt covenant hypothesis, and the political cost hypothesis, generate testable predictions about the association between firm characteristics and accounting method choices, providing a bridge between the theory of the firm and the empirical capital markets research discussed throughout this handout. Core research questions. 1. Information content. Do earnings announcements convey new information to the market? This is the question Ball and Brown and Beaver addressed, and it remains central to the literature. 2. Market efficiency. How quickly and accurately do prices adjust to accounting information? Research on post-earnings announcement drift (PED) has shown that prices do not fully adjust immediately, challenging the semi-strong form of market efficiency. 3. Cost of capital. Does the quality of financial reporting affect a firm's cost of equity or debt? Studies examine whether better disclosure, higher accrual quality, or more transparent reporting reduces information asymmetry, and thus the risk premium demanded by investors. 4. Disclosure and information asymmetry. How do voluntary and mandatory disclosures affect the information environment? This substream examines analysts following bid-ask spreads and institutional ownership as proxies for information asymmetry. Key methodologies. Event studies. Measure abnormal returns around information events, earnings announcements, restatements, SEC filings, using the market model or factor models. Association studies. Examine long window associations between accounting numbers, earnings, book value, and stock prices or returns using regressions such as the earnings returns model or the price levels model. Earnings response coefficients. ERCs estimate the slope coefficient in regressions of abnormal returns on unexpected earnings, capturing the market's valuation of $1 of earnings surprise. Cross-sectional determinants. Explore how firm characteristics, size, leverage, growth, auditor quality, moderate the relationship between accounting information and market outcomes. There are some influential contributions from Ball and Brown, who introduced the CAR methodology, Beaver, who documented trading volume spikes, Bernard and Homas for post-earnings announcement drift, Kothari for comprehensive field reviews, and Deckhow, Gu and Schrand on earnings quality proxies. These studies provide a robust foundation and empirical evidence, enabling scholars to understand market reactions to financial disclosures and refine future research directions. Current frontiers. Contemporary CMR extends in several directions. First, researchers investigate the role of non-GAAP earnings, social media, and alternative data sources, satellite imagery, credit card transactions, in the price formation process. Second, there is growing interest in how machine learning and textual analysis of corporate disclosures, 10K filings, conference calls, Twitter, relate to market outcomes. Third, the international dimension of CMR has expanded, with studies examining how institutional differences, IFRS adoption, and enforcement regimes affect the informativeness of accounting across countries. Finally, researchers increasingly study private capital markets, examining disclosure dynamics where traditional market-based metrics are unavailable. Unanswered questions and open puzzles. The PAD puzzle. Post-earnings announcement drift has persisted for over 50 years since its discovery. Why hasn't arbitrage eliminated this anomaly? Is it a risk premium, limits to arbitrage, or investor inattention? The persistence of PAD remains one of the most embarrassing challenges to the efficient markets hypothesis. The private firm information gap. Most CMR focuses on publicly traded firms with rich market data. How does accounting information function in private capital markets, where there are no stock prices, limited analyst coverage, and minimal disclosure requirements? Does the information content of accounting differ fundamentally in private settings? The declining timeliness puzzle. If capital markets have become more efficient over time, why do some studies suggest that accounting earnings have become less timely in reflecting economic events? Is this a measurement artifact, or does it reflect a genuine shift in the information environment toward non-accounting sources? Causality in disclosure research. Most disclosure studies document associations between disclosure quality and capital market outcomes, e.g., lower cost of capital. But establishing causality has proved elusive. Does better disclosure cause lower cost of capital? Or do firms with inherently lower risk choose to disclose more? The role of accounting in the age of alternative data. With the explosion of alternative data sources, satellite imagery, credit card data, social media sentiment, web traffic, how much incremental information do traditional financial statements still provide? Will accounting become less relevant? Or does it serve a fundamentally different, contracting/stewardship role that alternative data cannot replace? This slide delves into value relevance research, examining how accounting numbers relate to market values. Value relevance research is a substream of capital market research that specifically asks whether particular accounting amounts, such as earnings, book value, cash flows, or other reported items, are associated with equity market values. A number is said to be value relevant if it has a predicted and statistically significant association with stock prices or returns. The underlying premise is that the stock market provides a benchmark for assessing the usefulness of accounting numbers as summary measures of the events that affect a firm's value. The intellectual foundation of value relevance research rests on the residual income valuation, RIV model, most formally articulated by Olson, 1995, and Feltham and Olson, 1995. The RIV model expresses stock price as a function of book value of equity and the present value of future abnormal, residual, earnings. This provides a theoretical justification for regressing stock prices on both earnings and book value, which is the standard empirical specification in this literature. The Olson 1995 model specifically decomposes stock price into three components: book value, abnormal earnings, and other information, not yet captured in the accounting system. This framework has been enormously influential because it gives researchers a clean theoretical link between accounting fundamentals and equity valuation. Core research questions. 1. Are accounting numbers associated with market values? This is the most basic question. Studies regress stock price or returns on earnings, book value, and cash flows to determine whether these numbers have explanatory power. 2. Has value relevance changed over time? A prominent debate centers on whether the relevance of traditional financial statements has declined due to the growing importance of intangible assets, which are largely unrecognized under GAAP and IFRS. 3. Do accounting standards affect value relevance? Researchers compare value relevance before and after changes in accounting standards, e.g. IFRS adoption, fair value measurement, lease capitalization, to assess whether new rules produce more useful information. 4. What is the relative and incremental value relevance of different measures? Studies decompose explanatory power to assess whether earnings or book value alone, or in combination, best explain prices, and whether cash flows add incrementally to accrual earnings. Welcome to Part 2. In this slide, we examine key methods and debates in accounting value relevance research. Key methodologies. Price level regressions. Olson model regress stock price per share on earnings per share and book value per share. The R superscript 2 captures the combined value relevance of the two accounting numbers. Return regressions. Regress stock returns on changes in earnings and levels of earnings. This approach avoids certain scale effects inherent in price level models. Incremental versus relative explanatory power. Decompose our superscript 2 into components attributable to each variable alone, relative, and the additional explanatory power each adds beyond the other, incremental, following the Thiel, 1971 decomposition. Cross-country comparisons. Compare value relevance across countries with different accounting standards, legal systems, and enforcement mechanisms to identify institutional determinants. Current value relevance research explores several emerging areas. The growing importance of intangible assets, R&D, brands, data, human capital, raises questions about whether traditional balance sheets adequately capture firm value. Researchers examine the value relevance of ESG disclosures, non-financial KPIs, and sustainability metrics. The adoption of IFRS 17, insurance contracts, and IFRS 9 financial instruments provides natural experiments for assessing whether new standards improve the price accounting relationship. Additionally, Researchers study value relevance in the context of digital assets and cryptocurrencies, where traditional accounting frameworks face novel challenges. Unanswered questions and open puzzles. The intangibles crisis. If intangible assets now represent the majority of firm value, and GAAP/IFRS largely expense them immediately, how useful can balance sheet book values be? Has value relevance truly held steady, as Collins et al. 1997 suggest? Or is the apparent stability masking a fundamental mismatch between what firms own and what the balance sheet reports? The R superscript 2 interpretation problem. What does it mean when the R superscript 2 from a price regression is, say, 60%? Is this high or low? Should we expect accounting to explain all of stock prices? The field lacks a theoretical benchmark for what constitutes good value relevance, making cross-study comparisons and trend analyses difficult to interpret. Value relevance versus contract relevance. As Lambert, 2001, and Jesdal, 1981, argue, accounting information serves both valuation and contracting purposes, and these roles may demand different measurement attributes. Can a single set of accounting standards simultaneously optimize both roles? Or is the pursuit of value relevance necessarily at odds with the stewardship function? Fair value and procyclicality. Fair value measurement tends to increase value relevance in stable markets, but does it amplify financial instability by creating procyclical feedback loops during crises? The 2008 financial crisis reignited this debate, and it remains unresolved whether the gains in relevance are worth the potential systemic costs. Non-financial metrics. If ESG scores, customer satisfaction indices, and employee engagement metrics are value relevant, should they be incorporated into financial statements or kept as supplementary disclosures? What is the appropriate boundary of the accounting system when non-financial information increasingly drives firm value? Part 3 reviews key methodologies and accrual models used in earnings management research. Earnings management, EM. Research examines whether and how managers use judgment in financial reporting and in structuring transactions to alter financial reports, either to mislead some stakeholders about the underlying economic performance of the firm, or to influence contractual outcomes that depend on reported accounting numbers. Earnings management can occur through two primary channels. Accrual-based earnings management, AEM, which involves choices within GAAP about the timing and recognition of revenues, expenses, and accruals, and real earnings management, REM, which involves altering the timing or structuring of actual transactions such as cutting R&D, accelerating sales, or overproducing to reduce unit costs. The theoretical foundation for earnings management research draws from several economic frameworks. Agency theory predicts that managers, as agents, may manipulate reported earnings to maximize their own compensation or job security at the expense of shareholders. Positive accounting theory, Watson-Zimmerman 1986, identifies three key hypotheses for accounting choices. The bonus plan hypothesis, managers choose income-increasing methods to maximize bonuses. The debt covenant hypothesis, managers choose methods to avoid covenant violations. And the political cost hypothesis, large firms choose income-decreasing methods to reduce political visibility. Information asymmetry between managers and outside stakeholders creates the opportunity for earnings management, while monitoring mechanisms, auditing, governance, regulation, serve as constraints. Point 1. Does earnings management exist, and how pervasive is it? Early research sought to establish the basic phenomenon. Studies document the prevalence of small earnings surprises just above zero, just above prior year earnings, and just above analyst forecasts, suggesting widespread management of reported earnings. 2. What motivates earnings management? Research examines specific settings including IPOs, SEOs, mergers, CEO turnover, debt covenants, regulatory thresholds, and management compensation as motivating contexts. 3. What constrains earnings management? Studies investigate the roles of audit quality, Big N versus non-Big N, corporate governance, board independence, audit committees, institutional ownership, analyst following, and regulatory enforcement, SOX, SEC scrutiny, in limiting opportunistic reporting. 4. What are the consequences of earnings management? Research examines whether earnings management leads to future restatements, securities litigation, loss of investor confidence, higher cost of capital, and lower future stock returns. Key methodologies: accrual models. The dominant approach to measuring accrual-based earnings management involves estimating discretionary accruals as the residual from an accrual expectation model. Real earnings management. Following Roy Chaudhary, 2006, researchers model abnormal levels of cash flows from operations, production costs, and discretionary expenditures to detect real earnings management. This approach recognizes that managers may prefer real manipulation when accrual-based methods face greater scrutiny, e.g. post-SOX. Distribution analysis. Bergstaller and Dykhev, 1997, introduced the approach of examining the distribution of earnings around key thresholds, zero earnings, prior year earnings. Discontinuities. Unusually few observations just below the threshold, and unusually many just above, provide evidence of earnings management without requiring estimation of discretionary accruals. An important theme in the recent literature is the trade-off between accrual-based and real earnings management. Cohen, Day, and Liss, 2008, documented a shift from AEM to REM after the passage of Sarbanes-Oxley in 2002, suggesting that increased regulatory scrutiny of accounting choices pushed managers toward real activities manipulation, which is harder for auditors and regulators to detect. This finding has significant policy implications. Accounting regulation that successfully constrains one form of earnings management may inadvertently encourage another form that is potentially more costly to shareholders because real manipulation destroys long-term firm value. Current earnings management research explores several important frontiers. First, researchers are applying machine learning and natural language processing to detect earnings management through linguistic features of corporate disclosures, such as tone, readability, and linguistic complexity. Second, there is growing interest in classification shifting, a form of earnings management where managers reclassify core expenses as special items to inflate core earnings without changing bottom-line earnings. Third, the interaction between tax avoidance and earnings management has received increasing attention, as firms may use the opacity of tax accounts to manage reported earnings. Fourth, researchers examine earnings management in private firms, where market-based constraints are weaker but debt covenant and tax motivations may be stronger. Finally, the role of technology and data analytics in both facilitating and detecting earnings management is an active area of investigation. Unanswered questions and open puzzles. The measurement problem. All accrual models for detecting earnings management are inherently noisy. Discretionary accruals are estimated with considerable measurement error, leading to both Type 1 and Type 2 errors. After decades of research, can we reliably distinguish intentional manipulation from legitimate business judgments reflected in accruals? Ball, 2013, argues that we cannot. The welfare implications puzzle. Is earnings management always harmful? Some scholars argue that a degree of smoothing can be informative. Managers use their private information to signal future performance through managed earnings. Distinguishing bad opportunistic manipulation from good informative smoothing remains one of the deepest conceptual challenges in this literature. The real earnings management measurement challenge. If real earnings management is more costly to shareholders than accrual manipulation, why do firms increasingly prefer it? Can we reliably measure REM, given that the same actions, cutting R&D, offering discounts, may reflect legitimate business responses to changing conditions rather than manipulation? The substitution and spillover dynamics. Cohen, Day, and Liss, 2008, showed that firms shifted from AEM to REM after SOX. But does regulation create a whack-a-mole dynamic where constraining one form of manipulation always pushes firms to another? If so, what is the optimal level of regulatory scrutiny? And is there an equilibrium? Earnings management in the AI era. As AI-powered auditing tools become more sophisticated at detecting accrual patterns, will managers develop more subtle forms of manipulation that are beyond algorithmic detection? Conversely, if AI can detect REM in real time through supply chain data and transaction patterns, will this fundamentally alter the incentive structure for earnings management? Although presented as distinct streams, These three research areas are deeply interconnected. Capital market research provides the overarching framework by demonstrating that accounting information matters for market participants. Value relevance research narrows the focus to specific accounting numbers and asks which ones the market prices. Earnings management research recognizes that the numbers being priced are not exogenously determined, but are themselves the product of managerial choices, discretion, and sometimes manipulation. The practical connections are numerous. Value relevance studies that find declining explanatory power of earnings may be partly reflecting increased earnings management that reduces the signal-to-noise ratio. Capital market studies on earnings response coefficients, ERCs, find that ERCs are lower when earnings quality is poor, a direct link to earnings management. Conversely, earnings management research relies on capital market outcomes, stock returns, pricing multiples, as benchmarks against which to assess the consequences of manipulation. For doctoral students, understanding these interconnections is critical for identifying research opportunities. Many of the most impactful recent papers sit at the intersection of these streams. For example, studies examining whether earnings management erodes value relevance, whether market participants can see through managed earnings, or how real earnings management affects the information content of earnings announcements. This final slide lists 5 essential survey papers in accounting research, serving as a cornerstone for further study. The citations include works by Kothari, 2001, Barth, Beaver and Landsman, 2001, Holthausen and Watts, 2001, Dekhau, Guan Schran, 2010, and Healy and Wallen, 1999. These surveys shape future scholarly inquiry for research.